Hey traders, Todd Gordon of tradinganalysis.com. This is the free video for Thursday, August 14th. And we are going to take a look at a trade that we put on today with our clients in the options service. And that is a short call credit spread in XLE, the energy ETF. There's been a lot of volatility in these energy names. And we wanted to kind of minimize the individual name risk and go into the ETF based on a good setup. So let's dive in. This is the XLE on the 3-hour chart. We are counting a good 5-wave pattern to the downside in progress. Here's your first wave, kind of a long second wave correction to the July 24th top. Then we decline down in 3. Now we're moving higher in 4. Now, here's one of the main rules of Elliott, okay? Wave 4 correction should not enter the territory of wave 2 correction. That becomes the point of invalidation, which becomes your stop loss, okay? So in the XLE, that point of invalidation is 98.63. We should not trade above that point. This is where we want to start getting involved in setting up the trade. Now, how long should wave 4 last? Typically, fourth waves will last, and I'm talking in terms of time, at least the time elapsed in wave 2. So using the Motive Wave software here, we've done a 4v2 time comparison. All right, not until we get out to August 16th is that the 61% time relationship, 100% is August 19th, and then 1.618, which is green, that's your ideal, that's August 24th. So if we know when this wave 4, for how long it should last, that's going to help us set up option trades. So we want to be short, not just the market, but short this implied volatility, which is escalated here in the energy names. Specifically, we go over to the Dow platform. Earlier in the day, it had a higher implied volatility, but it was up around 40–45% here in the IV rank. And it's actually not a percent, it's a range from 0 to 100. Anytime it's up around the 50 level and a little bit lower for ETFs around the 40 level, that's a good time to be selling premium. And that's what we wanted to do. So we want to take a bearish stance, but also we want to be a bearish player in terms of volatility compression, especially as we move into this fourth wave consolidation. So if we think 1, volatility is going to compress, and 2, the market should at least go sideways and possibly down, we want to begin to sell this elevated premium above your wave count validation, which is above 98.63. So the trade we put on today was we sold the 98 calls in September for about $1.02, and we bought the 100 calls. So we did a 98-100 call credit spread in September. We got about, I think it was 57 cents, 58 cents for it, okay? And as Doe points out here, which is great, if the stock is greater than or equal to 98.56 at the close, you have a max loss. Notice that 98.56 is right on top of wave count validation. All right, so we've set up this option structure to take advantage of the Elliott Wave count. We have higher implied volatility in these energy names, so we're selling volatility. And if basically XLE just wants to go sideways, that's fine. If it wants to go down, that's fine. Or even if it wants to kind of trickle up to the upside, but not break that wave count and validation, that's fine too. All right, guys, so be sure to like this video, subscribe, so we can have these videos sent to you automatically. And hope it helps, guys. Appreciate the feedback. And again, if you want me to look at a stock, just type it in the comment section. Anything down there. Questions, comments, insults, whatever you want. All right? Thanks, guys. See you soon.